Hello everyone. Back in April, I commented on the Securities and Exchange Commission charges against Goldman Sachs. In the wake of that lawsuit, Goldman's stock price plunged 18%, erasing $15 billion in market cap in just one day. And it just wasn't Goldman Sachs that took the hit. Markets worldwide turned south on the news. Since then, the company has fared much better. Goldman Sachs settled the SEC for $550 million. That was considered a lofty price tag by some who thought the case was a witch hunt, but Goldman Sachs is able to absorb the cost easily. Then today, Goldman Sachs reported second quarter earnings of 78 cents per share. The good news is that the results would have been better if not for the SEC settlement and a $600 million UK banker's tax. The bad news is that even with those liabilities, Goldman Sachs still would have missed expectations, which were for nearly $2 a share. Let's not forget that we have seen Goldman Sachs blow away earnings quarter after quarter, and analysts inflate their numbers to accommodate the banker's usual upward surprise. So, how did the stock fare after those disappointing results? Before this morning's conference call, it was down as much as 3%. However, we all know the conference call can be a game changer, and boy was it ever. CFO David Vignard called the SEC settlement the right outcome for the firm, our shareholders, and our clients. He also suggested that Goldman Sachs was operating risk-averse and keeping high levels of capital and liquidity on hand. The stock since is up more than 2%. I suspect the rally was due not only to the conference call, but also to the likelihood that the financial regulation won't be written for over a year. I do have one question. Could the downward rally that was provoked by Goldman Sachs back in April be halted by a more positive outlook for Goldman Sachs? Well, the truth is in the tape, and we shall soon see. Thank you very much. This is Mandeep Rai for Weiss Research.